Good morning and namaskar to all those who have joined us for today's webinar. My name is Rahul Datta and I am Director Marketing at MBG Corporate Services. It is my pleasure to be the host for today's session. The Honorable Finance Minister Srimati Nirmala Sitharaman presented the Union Budget for 2023-24 on 1st February 2023, which is a blueprint drawn in Amrit Kal to commemorate 75 years of Indian independence. And this is a blueprint drawn for India at 100, which is 100 years from India's independence, which is 2047. Budget 2023 reflected the momentum and potential of India's economy to head towards a bright future. Indian economic growth is estimated at 7% for the current year, which is high as compared to other major economies of the world. To service these focus areas in the nation's journey to India at 100, the budget identifies 4 transformative opportunities: economic empowerment of women, PM Vishwakarma Kaushal Samman, PM Vikas, tourism, and green growth. The proposed measures are right steps towards overall economic development of India and should be accepted and implemented by all stakeholders in the same spirit to achieve the desired objective of future-ready India. We are pleased to present herewith an analysis and insights of the proposals of the Union Budget of financial year 2023-24 and sincerely hope that these shall be found useful to the audience. In this webinar, our speakers will help demystify the budget. If you have any questions, please type in the Q&A box and we will contact you via email after the webinar with our responses. So let's have a look at today's agenda. First, I will take you through a brief introduction of our organization. Then Mr. Malhotra will give an overview of the macroeconomy, policy reforms, and initiatives of the budget. Next, Mr. Janardan Singh will give you insights and overview on the direct tax provisions of budget. Our last speaker of the day, Mr. Vaibhav Matta, will shed light on indirect tax provisions of budget 2023-24. So a brief look about who we are. We are MBG Corporate Services, an international professional services organization providing consulting and advisory services to business at all stages of their life cycle. Established in 2002, we are a 600-member strong team that operates from a network of 19 global offices spread across 8 countries: India, Japan, Singapore, China, Germany, Oman, Qatar, and the United Arab Emirates. Our experience of more than 2 decades has enabled us to serve over 3,000 clients globally. We are proud to be working with 100 of the Fortune 500 companies, as well as several other reputed local family business groups. A unique feature of our organization is the multinational foreign enterprise group, which services clients in their domestic market and through our global offices. It helps in bridging technical, cultural, and linguistic barriers. Our practice and service areas for our India operations include risk advisory services, transaction advisory services, taxation advisory and compliance services, financial reporting and assurance, corporate and other regulatory services, as well as human capital consulting. So I would like to introduce our first speaker of the day, Mr. Malhotra. Mr. Malhotra is Associate Partner, Legal and Corporate Secretarial at MBG Corporate Services. He has more than 12 years of post-qualification experience in advising various domestic and international clients in the field of general corporate advisory involving foreign exchange laws, foreign trade laws, Companies Act 2013, and Insolvency and Bankruptcy Code, compliance management, and regulatory services. He has advised several foreign clients in setting up their subsidiaries and liaison offices, branch offices in India, and providing post-establishment compliance services under various laws in respect of their Indian businesses. So without much of waiting, I will now like to invite Love to start his presentation on macroeconomy, policy reforms, and initiatives of budget 2023-24.
Good morning, everyone. Thank you, Rahul, for introducing me. I'll start my session with macroeconomy. The economic survey presented a picture of how the economy had performed in the year 22-23, as well as the projections for GDP and other macro parameters in coming years. The Economic Survey 22-23 has been written after the COVID-19 blow and amid global geopolitical developments. Let's find out what Economic Survey has in store for all of us. Today, India finds its place as the 5th largest economy in the world, surpassing Great Britain, and is likely to reach 3rd place by 2035. India's economic growth in financial year 23 has been principally led by private consumption and capital formation, which has helped to generate employment in the country. The Economic Survey, as you can see on the slide, revolves around GDP, fiscal deficit, inflation, and forex reserves. Let me quickly take you through them one by one. Let us first talk about GDP growth. Well, as per the survey, the Indian economy seems to be in a decent position to witness GDP growth of 7% in 22-23, followed by 8.7% growth in previous financial year. Despite the 3 waves of pandemic, Russian-Ukraine conflict, and the raising of rates by central banks globally in order to manage inflation, leading to appreciation of US dollars and, of course, widening of current account deficits, India has been recognized as one of the fastest growing economies. Having said that, the impact of the pandemic has resulted into a major downfall in GDP growth in financial year 21, as you can also see on the slide. However, the quick recovery from virus in the 3rd wave has minimized the loss of economic output during the last quarter of 22. As a result, the output in financial year 22 went past its pre-pandemic levels in financial year 20. In spite of the challenges faced by Indian economy, India's GDP growth is expected to remain robust in financial year 24, that is in the range of 6 to 6.8%. Now let us talk about foreign exchange reserves. Adverse global economic situation had placed India's balance of payments under a lot of pressure in financial year 22, but the survey noted that easing of crude oil prices and resilient inward remittances would result in reducing the current account deficit during remaining period of financial year 23. For financial year 23, government is optimistic that India has sufficient reserves to finance the current account deficit and thereby intervening in the Indian rupee. Next slide, please. Let me now talk you through the fiscal deficit. According to the survey, fiscal deficit is expected to be at 6.4% of GDP in financial year 23. The survey highlighted that conservative budget assumptions provided a cushion during global uncertainties. The resilience in the fiscal performance was due to a recovery in economic activity and buoyancy in revenues. As per the survey, the fiscal deficit is estimated to be 5.9% of GDP by financial year 25. However, government through its proposed measures aims to bring it down to even below 4.5% by financial year 25-26. The next major aspect for economic survey has been inflation. As is appearing on the slide, consumer price index, which is mainly responsible, or I would say reflect inflation, increased from 4.8% in 1920 to 6.8% in 22-23, which was even beyond the RBI's tolerant limit of 6%. Well, the reason for rise in inflation was, of course, disruptions in supply chains of essential goods like food, medicine, industrial goods on account of pandemic, which was further affected by the effects of conflict in Russia-Ukraine, resulting into increase in prices of crude oil and other commodities. Having said that, the rise in inflation rates in India is still better off as compared to other advanced economies, wherein the inflation rate has gone from 3.1% in 2021 to 7.2% in 2022, highest ever in 1982. Let me now walk you through the sectors which has contributed to growth and development of Indian economy in financial year 22-23 till now. So the first sector which has contributed to the growth is agriculture. It has always been the this sector. This sector is something which is very important for the economic growth. As appearing in the slide, the average growth rate in agriculture and allied sector was 4.6% during last 6 years. In 2021, the Indian exports from agriculture and allied products reached an all-time high of USD 50.2 billion with a growth of 18% over the previous year. It is expected that financial year 22-23 will end with agriculture sector standing at 3.5% as compared to 3% of 21-22. The next sector which has contributed to the overall economic growth has been service sector. Well, we all know due to effects of pandemic, there was a decline in the growth of service sector in financial year 22. However, the optimistic growth forecast in service sector in financial year 23 till now, as appearing on the slide also, results from a number of positives like the rebound of private consumption, giving boost to manufacturing, higher capex, universal vaccination, the return of migrant workers to construction sites, banks becoming ready to extend the credit, thereby enabling excess of credit, especially to MSME sector. Now I'll move on to the next sector, which is electronic sector. So I would call it as an electronic manufacturing sector, to be specific. The electronic industry continues to be vital for the socio-economic development of a country. The domestic electronic industry in 2020 was valued at USD 118 billion. The exports of electronic goods increased from USD 8.9 billion in 21-22 to USD 13.8 billion in 22-23. Now, India aims to reach USD 300 billion worth of electronic manufacturing and USD 120 billion in exports by financial year 26. In this budget specifically, government seems to be focusing on boosting the indigenous manufacturing. Accordingly, it has given an outlay of USD 760 billion to semiconductors to specifically boost indigenous manufacturing and reduce dependence on import. This clearly shows that India is on the right path to achieve this target. So let us now move on to the Union Budget 2023-24. Well, this year's budget, well, it's a very solid budget with an all-round inclusive and futuristic approach focused on capex and green growth. This is the first budget of Amrit Kal, which is based on government's 3 vision, or I would call it focus areas of ample opportunities for the citizens, especially focusing on youth, providing strong impedance to growth and job creation, and strengthening of macroeconomic stability. Well, here for everybody's reference, Amrit Kal refers to the next 25 years, that is up to 2047, leading to the centenary of India's independence. To service these focus areas, government has recognized 4 opportunities to be transformative. That is economic empowerment of women, PM Vishwakarma Kaushal Samman, tourism, and green growth. This year's budget revolves around Saptarishi. That's what we call 7-star, which are being termed as 7 priorities in the budget. So I'll just walk you through those priorities. So first of those priorities, inclusive development. Basically, this is based on government's philosophy of Sabka Saath, Sabka Vikas. That's everyone's support for everyone's development. For farmers, women, youth, OBCs and other backward classes, with special focus on areas like Jammu and Kashmir, Ladakh, and Northeast. The second priority has been reaching the last mile. To focus on this, the government has formed ministries of Ayush, fisheries, animal husbandry and dairying, skill development, Jal Shakti, etc. Next one is infrastructure and investment. This budget focuses on gearing up for virtuous cycle of investment and creation of job opportunities. So that's the reason government has allocated a lot of funds to this sector, which I will explain in the later slides. Next one is the unleashing the potential. This is based on government's commitment providing a transparent and accountable administration required for the betterment and welfare of the common citizen. Next one is very important, green growth. Government understands the importance of environmentally conscious lifestyle, and this year's budget thus focuses on becoming a net zero carbon emission by 2070. Next one is youth power. Government has special focus on youth growth and development, and thus has formulated the national education policy, focusing specially on skill development and thereby facilitating job creation and business opportunities for the entrepreneurs. Next one is financial sector. Well, government has come out with various reforms in financial sector, which has helped ease of access to credit, faster service delivery, etc. This budget proposes to bring similar measures. So, though government has in this budget divided the whole announcement of its measures into sub-3, we have, for everybody's reference, categorized these announcements into various sectors, which you can see on the screen right now. It's agriculture, healthcare, physical infrastructure, digital infrastructure, social infrastructure, green energy, and finance. So let us have a quick look at them one by one. I'll start with agriculture. Well, as discussed under the macroeconomic section in the previous slides, agriculture continues to be the biggest contributor to India's GDP. In this budget 23-24, the FM announced a bunch of new initiatives, starting from setting up of a digital public infrastructure to enable inclusive farmer-centric solutions, which would eventually support the growth of agri-tech industry and startups. Setting up of agriculture accelerator fund to encourage agri startups of youth entrepreneurs in rural areas by transforming agriculture practices to enhance productivity and profitability. Then there has been a proposal to boost availability of disease-free quality planting material for high-value horticulture crops. Government also focuses on making India a global hub for millets. That's what is called Shri Ann in the budget. Next important sector which I would like to explain is healthcare sector. Well, the announcement made by government in this year's budget is a welcome step to address the long-standing gaps in the Indian healthcare ecosystem, especially with the opening of new hospitals. A lot of nursing staff would be required. Proposals such as outlays by the government in medical research is considered to be a magnificent move. Further, government's move to take measures for elimination of sickle cell anemia by 2047 by creating awareness, screening in the affected tribal areas and counseling is very much appreciable. The next one I would talk about the infrastructure sector, where all the spending has been the government has been doing, and they have a lot of plans to do it as well. I'll start with the physical infrastructure first. By virtue of this budget, the government have allocated outlays towards various areas as part of physical infrastructure. The highlights of these measures have been to encourage investment in infrastructure. There is a proposal to extend the term of interest-free loan granted to state governments with a validity of 50 years for 1 more year. For logistics and connectivity, proposal has been made to allocate INR 2,400 billion to railways. 100 critical transport infrastructure projects have been identified for last and first mile connectivity for ports, coal, steel, fertilizers, and food grain sector. Further, proposal has been made for revival of 50 additional airports, heliports, water aerodromes to improve the regional air connectivity and rail connectivity. Government has proposed a concept of developing a unity mall in the state capital, or I would say most prominent tourism center or the financial capital, for promotion and sale of their own one district, one product. Government has taken a lot of measures for the educational sector as well. Well, there is a proposal to set up physical libraries at village panchayats and ward levels, and also appointment and recruitment of 38,800 teachers and support staff for about 740 Eklavya model residential schools in next 3 years. Next, I will move to the digital infrastructure. Well, as we all are aware that our digital infrastructure helped us a great deal in managing the biggest crisis of the era, that was pandemic. It was imperative that a proposal for spending is made towards digitization as well. The initiative of the government towards setting up of AI infrastructure is definitely a welcome move, as it is likely to improve agriculture and health sector specifically. Launching of national data governance policy to enable access to anonymized data shows government's intention towards maintaining security of national data. Further, setting up of digital national libraries for children and adolescents, physical infrastructure in village panchayat, skill development, I would say will do wonders for improving our education system in India. Phase 3 of e-courts project will also be launched for expeditious conduct of proceedings and giving convenience to the parties to the proceedings. There is also a proposal of simplification of KYC norms by financial sector regulators. Even the facilities for DigiLocker have been increased, making it useful for both individuals and entities to online store documents and share them online with various authorities, regulators, banks. Government also aims to set up a network of 100 labs to develop applications by using 5G services in engineering institutions for new business models and employment potential. Next, I will talk about social infrastructure. With the success of aspirational district program, government has recently launched aspirational blocks program, covering about 500 blocks for saturation of essential. Government has launched a lot of measures in social infrastructure. With the success of aspirational district program, government has recently launched aspirational blocks program, covering about 500 blocks for saturation of essential government services such as health, nutrition, education, agriculture, water resources, skill development. Further, there has been a proposal to launch a Pradhan Mantri PVTG mission to improve the socio-economic conditions of the particularly vulnerable tribal groups. The next important sector has been green energy. Well, we all know climate action and sustainability have been a key topic of discussion as well as implementation, especially in the last year, not just in the country, but on various global platforms, as well as G20, World Economic Forum, etc. Accordingly, the investment in green energy is the need of the hour to curb the pollution levels and thereby improving the overall health of the citizens of the nation. In this regard, government has taken a lot of effective measures under green energy in this union budget. Starting from launching of green hydrogen mission to curb the levels of carbon and introduce dependence on the fossil fuels such as coal, oil, natural gas sector. Government targets to achieve annual production of 5 million metric tons by 2030. Allocation of about INR 350 billion towards priority capital investments towards energy transition and net zero objective. There has always been a proposal to scrap old vehicles. So here also the government has proposed scrapping of old vehicles and even ambulances of central and state government officials. The next important sector is financial sector. Well, the financial sector for any economy is kind of a backbone as it responds dynamically to the movements in the global economy. The financial sector has been hoping that the government shall announce some path-breaking measures to push growth in the sector. Keeping this in mind, this year's budget has brought a lot of reforms in this sector. So I'll just walk you through those measures. Starting from setting up of a national financial information registry in consultation with regulators like RBI, which aims to improve flow of credit, foster financial stability, etc. proposals to reduce, ease, and simplify compliance costs. Financial sector regulators, RBI, NABARD, SEBI, IRDA would carry out comprehensive review of existing regulations. And for this purpose, even public suggestions would be requested, and even suggestions from regulatory entities will also be requested. The next one is capacity building in securities market, which would kind of ensure that more and more functionaries and professionals can be made available. This will be done specifically by the financial regulators SEBI by developing standardized norms for education in National Institute of Securities Market. Of lately, stakeholders have been facing a lot of issues in claiming their shares and dividend back, which has not been reclaimed or requested. So in this regard, the government has taken and initiated, in fact, a process of developing an integrated IT portal, which would help the stakeholders to reclaim their unclaimed shares and unpaid dividend from the Investor Education and Protection Fund Authority at a ease level. So let us now talk about some reforms for MSME. Well, we all know that the intention of the government has always been to significantly boost MSME. In this budget, government has taken various measures for MSME. Let us have a quick look at these. So government has made a proposal for revamping of credit guarantee scheme for MSME. This would enable additional collateral-free guaranteed credit of about INR 2,000 billion. Further, even the cost of credit will also be reduced by 1%. In order to provide relief to MSME, government has proposed to return 95% of the amount related to the performance security forfeited due to non-performance of government agreements at the time of COVID. Well, there has been some other areas which we have categorized under the heading other key focus areas. So I'll quickly walk you through those reforms. Proposals to indemnify identify 50 destinations to promote domestic as well as foreign tourism. In this regard, government has taken an initiative like Dekho Apna Desh, which says, see, cherish your nation and its progress. That will be encouraged to promote domestic tourism over international tourism. The second major focus area apart from this has been Vivad Se Vishwas 2 scheme, that is from dispute to trust. So launching of voluntary settlement scheme wherein contractual disputes with government and government undertakings can be resolved expeditiously. Then, as I have explained in my earlier slides, this year's budget specifically focused on encouraging youth. So for this purpose, a pan-India national apprenticeship promotion scheme will be launched to provide stipend support to 4.7 million youth in next 3 years. My next topic would be an interest to everyone because we all keep on saying that government should take a lot of steps for making the business opportunities and the compliance burden as minimized as possible. So Indian government has been taking a lot of steps in this regard. So let us just go through those initiatives taken in this budget and overall so far. So I would say government has been taking consistent measures time and again to boost the initiative of ease of doing business in India. Some of these are to ease compliance burden. Government has reduced more than 39,000 compliances and decriminalized more than 3,400 legal provisions. Government also has a proposal to set up a central processing center to ensure faster response to companies on various filings made with the regulators, especially registrar of companies under the provisions of Companies Act. Government has also introduced Jan Vishwas bill to basically amend 42 existing central acts in order to encourage trust-based governance, to set up a single window IT system for registration and approval from various regulatory authorities such as RBI, GSTN, SEBI, IRDI, etc. The next major initiative taken by the government has been to streamline the provision of Special Economic Zone Act to avoid dual regulation by amending IFSCA. Then PAN number has been identified as a common identifier for all digital systems. Recently, MCA, Ministry of Corporate Affairs web portal has been revamped, wherein about 56 statutory forms which are required to be filed with the Register of Companies have been migrated to V3 portal from the V2 portal. Then government has developed a unified filing process for simplification of forms, returns, etc. Now, even in the banking sector, a lot of correspondings keep on happening. So there is, of course, a need to make the process simpler. That is the reason government has proposed amendment in the Banking Regulation Act, Banking Companies Act, and of course the RBI Act to improve overall bank governance and enhance investor protection. So to sum up, I would like to state that the proposed measures announced in this budget shows clear intention of the government to make India a preferred investment destination and thereby laying the foundation to a USD 5 trillion economy, be it massive capital outlay in railways amounting to INR 2400 billion, needful measures taken in agriculture sector, INR 750 billion allocated for critical transport infrastructure for first and last mile connectivity, revamped credit guarantee to MSMEs with infusion of about INR 90 billion, INR 350 billion towards energy transition, and requisite measures taken for enhancement of skill of youth, and of course, last but not the least, ease of doing business initiatives. So with this, I would like to end my session. Thank you so much for your patient listening. Over to you, Rahul.
Thank you so much, Love, for that very insightful and informative session on macroeconomic overview. Next, we would like to, touch upon the direct tax provisions of budget 2023-24. And for this, we have our India COO and partner of direct tax, Mr. Janardan Singh. Mr. Janardan Singh is COO at MBG Corporate Services India and has more than 16 years of experience in tax consulting, dealing with matters pertaining to corporate tax, international tax, transfer pricing, and expatriate tax. He has worked on issues related to permanent establishment, source-based taxation of income, such as royalty and fee for technical services, and has significant experience in the area of inbound expatriates and cross-border tax advisory from a tax and regulatory perspective. He has done extensive representations at assessment and appellate level on the issues of permanent establishment, expatriate taxation, and taxation on the basis of source rule for several corporate entities. He is a qualified chartered accountant and holds degree of Bachelor of Commerce from University of Delhi. So without further ado, I would like to invite Mr. Janardan Singh to take us through this session.
Good morning, everyone. In this session, we are going to discuss the direct tax proposals of the Union Budget 2023. We can start with the amendments proposed related to individuals. So there is no change in old tax regime. On the other hand, tax exemption limit has been increased to INR 3 lakh under new tax regime with change in slab structure. As per the new slab, income from 0 to 3 lakhs shall be taxed at nil rate. 3 to 6 lakhs shall be taxed at 5%, 6 to 9 lakhs shall be taxed at 10%. 9 to 12 lakhs shall be taxed at 15%, and 12 to 15 shall be taxed at 20%, and above 15 lakh shall be taxed at 30%. So various provisions have been proposed to make new tax regime more attractive, such as no tax on income up to INR 7 lakh. New tax regime shall be the default tax regime, with option available with the taxpayer to opt for old tax regime. Surcharge rate is reduced from 37% to 25% in the case of income exceeding INR 50 million. Deductions allowed under new tax regime are standard deduction, family pension, and deposit in the Agniveer Corpus Fund. So currently, any receipt of money in excess of INR 50,000 without any consideration from resident is considered as income deemed to accrue or arise in India in the hands of non-resident. It is now proposed to be considered as income deemed to accrue or arise in India in the hands of resident but not ordinary resident. This amendment shall be effective from assessment year 2024-25. So in case of lotteries, crossword puzzles, races, card games, gambling, betting, TDS are not deducted by splitting such receipts in multiple transactions below INR 10,000 per transaction. So in order to restrict such splitting of transactions, it is proposed to amend applicability of TDS in case of winning from amount of INR 10,000 per transaction to INR 10,000 only, with effect from 1st April 2023. Secondly, winning from online game have been proposed to tax with TDS at the rate of 30% with effect from 1st July 2023. So in order to clarify the intent of legislature, it is proposed that benefit or perquisite provided in cash or in kind or partly in cash and partly in kind shall be taxable, and TDS provisions shall also be applicable. This amendment is effective from assessment year 2024-25. Threshold limit of presumptive taxation scheme has been proposed to increase from INR 20 million to 30 million in case such cash receipts of business does not exceed 5% of total sales, turnover, or gross receipts. And simultaneously, the threshold limit of profession has been increased from INR 5 million to INR 7.5 million, provided that cash receipts of profession does not exceed 5% of total gross receipts. And this amendment is effective from assessment year 2024-25. So yes, in this slide, we are going to discuss about the gold. It is proposed to exclude the conversion of physical form of gold into electronic gold receipt and vice versa from the preview of transfer for the purposes of capital gains with effect from assessment year 2024-25. And there is one more change, that the cost of acquisition of the electronic gold receipt for the computing the capital gains shall be deemed to be the cost of gold in the hands of person in whose name electronic gold receipt is issued, and holding period would include the period for which gold was held by the taxpayer prior to its conversion into electronic gold receipt. So presently, where a company, not being a company in which the public are substantially interested, receives from any resident person any consideration for issue of shares that exceeds the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value of the shares is taxable. This is not applicable to the consideration received from non-resident. Now it is proposed to be applicable for receipt of consideration for issue of shares from any person, irrespective of the residential status, and it shall be applicable with effect from assessment year 2024-25. A deduction is available under section 54 on the long-term capital gain arising from transfer of a residential house, if the capital gain is reinvested in a residential house. Now, and the deduction is also available under section 54F on the long-term capital gain arising from transfer of any long-term capital asset, except a residential house, if the net consideration is reinvested in a residential house. These deductions are proposed to limit to maximum deduction of INR 100 million now, and it shall be applicable with effect from assessment year 2024-25. Sums received from life insurance policies are tax exempt. In case premium payable for any of the years during the terms of the policy should not exceed 10% of the actual capital sum assured. And now it is proposed to tax sum received from insurance policies other than ULIP having premium or aggregate of the premium above INR 5 lakh in a year. However, it shall be exempt if received on death of the insured person, and it shall be applied for the policies issued on or after 1st April 2023. So we can now move to proposals related to corporate taxes, and there is no change in tax rates proposed for there is no proposed tax rate change for the corporate taxpayers for the financial year 2023-24. In case turnover for the financial year 2021-22 of the domestic companies does not exceed INR 4,000 million, the rate of income tax shall continue to remain 25% of the total income, and in all other cases it shall be 30% of the total income. Further, in case of companies other than domestic companies, the rate of tax remains 40% of the total income, and there is no change in surcharge and cess for the corporates, and it is proposed to insert new section 115 BAE in case of new manufacturing cooperative society set up on or after 1st of April 2023, which commences manufacturing or production on or before 31st March 2024. They have option to opt for the concessional tax rate of 15% subject to foregoing of certain incentives or deductions. So this amendment shall be effective from the assessment year 2024 and 25. So section 80G provides the list of funds to which any sum paid by the taxpayer is eligible for deduction to compute taxable income. It is proposed to remove Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, and Rajiv Gandhi Foundation from such list. Accordingly, donation to these funds shall not be eligible for deduction under section 80G. This amendment will take effect from assessment year 2024-25. Presently, the order of assessment or reassessment under section 143 or section 144, where income tax return is furnished under section 139 subsection 1 or updated return furnished under section 139 subsection 8A relating to assessment year commencing on or after 1st April 2021 are to be passed within a period of 9 months from the end of relevant assessment year or 9 months from the end of the financial year in which updated return is filed. The time limit to pass the order of assessment or reassessment relating to assessment year commencing on or after 1st April 2022 is proposed to be extended to 12 months instead of 9 months, and it is also proposed to provide additional time for assessments or reassessment where search under section 132 or requisition under section 132A has been made in relation to ongoing assessment. The period of limitation of pending assessments shall be extended by 12 months, and the period of 12 months is also applicable in case where order under section 263 or 264 is to be passed for revision of assessment or reassessment. And this amendment will take effect from 1st April 2023. No TDS is required to be deducted in respect of payment of interest on certain securities, where the securities are in dematerialized form and listed in a recognized stock exchange. Now, such exemption from TDS on interest payment on listed debentures is proposed to be withdrawn with effect from 1st April 2000. So, if market-linked debentures are held for more than 12 months, it is taxed as long-term capital gain at the rate of 10% without indexation, and if held for less than 12 months, it is taxed as short-term capital gain as per the existing applicable tax rates. It is proposed to tax the capital gains arising from transfer or redemption or maturity of market-linked debentures as short-term capital gains, irrespective of the period for which this market-linked debentures are held. The cost of acquisition of such debentures and any expenses incurred in connection with the transfer can be reduced to compute capital gains on transfer of market-linked debentures. This amendment will be applicable from assessment year 2024-25. Section 206C provides for TCS on foreign remittance through the liberalized remittance scheme LRS and on sale of overseas tour package. It is proposed to amend this section to increase TCS on certain foreign remittances and on sale of overseas tour package, and it is now proposed to increase the rates of TCS on overseas travel and foreign remittances made other than for the purpose of education and medical expenditure from 5% to 20% on the amounts remitted during the financial year without any threshold. And this amendment will be effective from 1st July 2023. Any information or document related to transfer pricing documentation is proposed to be now furnished within a period of 10 days instead of 30 days from the date of receipt of a notice in this regard, and the period of 10 days can be further extended for the maximum period of 30 days on an application made in this regard. This amendment will take effect from 1st April 2023. Sometimes it is seen that TDS is deducted on payment basis, but the income was declared on due basis in the income tax returns, and TDS is deducted at the time of payment, which is in subsequent years only. Where any income has been included in the return of income for any assessment year and TDS has been deducted on such income and deposited in a subsequent financial year, the assessee can make an application to assessing officer within 2 years from the end of the financial year in which such TDS was deducted. So now section 154 related to rectification of mistakes shall also apply in this case, and the period of 4 years shall be calculated from the end of the financial year in which such TDS has been deducted. It is proposed that the interest on refund arising out of above rectification shall be from the date of application to the date of grant of the refund. These amendments will take effect from 1st October 2023. Section 206 AB and Section 206 CCA provides for special provisions for higher TDS or TCS for non-filers of income tax returns, and these non-filers in these sections are referred to as a specified person, as there are persons who are not required to furnish the return of income. It is proposed to amend the definition of a specified person to exclude a person who is not required to furnish the return of income for the year and who is notified by the central government in this regard. So this amendment will take effect from 1st of April 2023. Now, to promote timely payments to MSMEs, amendment is proposed in section 140, section 43B, and any sum payable to MSME shall be allowed as deduction on actual payment basis, and if the same has been paid in compliance with section 15 of the MSME Act. However, there is a proviso to section 43B, and that shall not be allowed to such payments, due to which it is irrelevant whether payment is made on or before the due date of filing income tax return. And this amendment will be applicable from assessment year 2024-25. To promote startups, a relief in the form of increase in the time limit for carrying forward and setting off of losses of eligible startups under section 80 IAC is proposed to increase from 7 years to 10 years from the date of incorporation. Eligible startups are allowed 100% deductions from the profits for 3 consecutive assessment years out of 10, on the condition that it is incorporated on or after 1st April 2016, but before 1st April 2023, which is proposed to be extended to 1st April 2024. This amendment will take effect from 1st April 2023. Taxpayers are required to maintain books of accounts wherein inventory is required to be valued at lower of cost or net realizable value, and the detailed mechanism is prescribed for this purpose under ICDS. So now it is proposed to enable the tax authorities to direct taxpayers to obtain an inventory valuation report from a cost accountant to ensure that inventory is valued correctly. It is also proposed that the time period to undertake inventory valuation will be excluded from the time limit for completing assessment by the tax authorities. So this amendment will take effect from 1st April 2023. Presently, sale consideration for computation of capital gains in the hands of individual or HUF on transfer of land or building under a joint development agreement is computed on the basis of stamp duty value of shares of individual or HUF as on the date of issue of completion certificate, and they also consider the consideration received in cash by such individual or HUF. So now it is proposed to include any consideration received by the individual through check or draft or by any other mode to arrive at the sales consideration. And this amendment will be applicable from assessment year 2024-25. Presently, a memorandum of cross objection before ITAT can be filed only in the case of appeal against the order of CIT appeal. It is proposed to enable filing of memorandum of cross objections in all cases against which appeal can be made to ITAT. And this amendment will take effect from 1st April 2020. So on this slide, we are going to discuss some provisions related to reassessment proceeding. Presently, an assessee is required to furnish the return of income against the notice issued for assessment, reassessment within the period as specified in such notice issued by the tax officer. And now it is proposed to provide that the time limit to furnish the return of income in response to such notice for assessment and reassessment is 3 months from the end of the month in which such notice is issued. However, further time may be allowed by the tax officer on request made in this regard. Any return furnished after the prescribed time limit shall not be considered as a valid return, and taxpayer is not required to issue, or tax officers are not required to issue any notice for in this regard. Further, where a search is initiated or search for which the last of the authorization is executed or requisition is made, after 15th March of any financial year, a period of 15 days shall be excluded for the purpose of calculating the time limit for issuance of notice under section 148, and notice so issued shall be deemed to have been issued on 31st March of such financial year. This amendment is effective from 1st April 2023. The units established in SEZ are allowed 15 years of tax benefit in case such units begin to manufacture or produce or provide services on or after 1st April 2005. The deduction is available for units that begin operations before 1st April 2020, which has been extended to 30th September 2020. And section 10AA does not provide for the conditions to file return of income within due date for claiming the deduction as is mentioned under similar exemption provisions. However, section 143(1) provides that a deduction under section 10AA shall be eligible only if the return is filed within due date. To align the provisions, it is proposed that no deduction shall be allowed to the SEZ units if return of income is not furnished by them within the due date. Presently, there is no prescribed time limit for timely remittance of export proceeds by SEZ for claiming deduction, as is mentioned under similar exemption provisions. So accordingly, it is proposed that the deduction under section 10AA shall be available only if the export proceeds is received in India in convertible foreign exchange within a period of 6 months from the end of the financial year. And this amendment will be applicable from assessment year 2024-20. This amendment is a step towards ease of doing business. The liquidator is obliged to set aside an amount to settle the income tax liabilities, and liquidator is not permitted to part with any assets of the company until the receipt of notice from tax authorities. So presently, failure to comply with above may result in prosecution of the liquidator, who may be subject to imprisonment ranging between 6 months to 2 years, and it is now proposed to decriminalize minor offenses, and no such prosecution proceeding may be initiated on or after 1st April 2023. And this amendment will take effect from 1st April 2023. So that's all from direct tax side, and thank you for attending the session. I am now handing over to Mr. Rao. Thank you.
Thank you so much, Mr. Janardan, for that very informative session on direct tax provisions. I'm sure it would have been of a lot of interest to our audience. And now we are moving to the last part of our webinar, which is indirect tax provisions of budget 2023-24, for which I would like to invite our partner of indirect tax, Mr. Vaibhav Matta. Mr. Vaibhav Matta is a chartered accountant and graduated from University of Delhi with a Bachelor of Commerce. He manages a portfolio of clients in the areas of indirect tax, customs, GST, indirect tax advisory, foreign tax trade policy, indirect tax compliance health check, and due diligence. He also represents multinational clients before the Indian tax authorities for conducting tax-related matters on their behalf. He has gathered strong experience in the area of indirect tax during his professional career, and without much ado, I would like to now invite him to take us through this session.
Thank you, Mr. Rahul, for the introduction. So a very good afternoon to all the participants. I would like to take an opportunity to thank you all for sparing your precious time to have a session on proposals in budget 23-24. So from indirect tax perspective, we will be focusing on the key amendments in customs, excise, and we will go through the clause by clause changes proposed under GST. So coming to the amendments under customs, first of all, I would like to tell you that there are few amendments in customs which would get affected from the next day of the budget itself. So there is a special act called Provision of Duty Collection Act, which gives an authority to the government of India to collect the tax in the nature of excise duty and customs from the midnight of the 1st Feb itself. So coming to the core objectives of the government while proposing the amendments under customs, it is very important to analyze what are the basic amendments to have an idea what amendments are announced by the government. We should focus on the objectives first. So what are those objectives? First objective is to promote the exports from India. Second objective is boost domestic manufacturing. Third objective is enhancing domestic value addition. And the last objective is encouraging green energy and energy mobility. In light of the above objectives, one can easily predict that the proposal in customs should include increase in the duty on import of final products and reduction in rationalization of the custom duty in raw material to boost the domestic valuation. Coming to the custom exemptions and tariff rationalizations. As already discussed above, in consideration of rapid growth in electronic sector, after introduction of phased manufacturing program by the government in the earlier budgets, and in order to further deepen the domestic value addition, the basic custom duty on certain parts like camera lens used in manufacture of camera module, cellular mobile phone, and on the open cells of TV panels is being relaxed. And the concessional duty on lithium ion cells for the batteries is also extended for another year. On the other side, BCD on electronic kitchen chimney is being increased, and on heat coils being one of its component, the BCD is being reduced. So this is being done to rectify the inverted duty structure first, and secondly, to encourage its manufacturing in India. Similarly, in order to encourage ethanol blending program and to facilitate energy mobility in India, on denatured ethyl alcohol is being exempted. Again, to boost the domestic manufacturing, there is an increase in custom duty on vehicles, including electronic vehicles, even in semi-knockdown form. However, custom duty is reduced on EV parts on import for the testing agencies and on capital machines for encouraging manufacturing of lithium-ion batteries in India. Also, in order to seize the global opportunity of depletion in deposits of natural diamonds, it has been seen that globally that the deposits of natural diamonds are falling. So the basic custom duty is being reduced on the seeds used in the manufacture of lab-grown diamonds to encourage its manufacturing in India also. So duties on articles made from bars of gold, platinum, duty on silver door has also been aligned and rationalized. The concessional duty on raw material of cold rolled steel and copper scrap is being maintained to enhance the productivity in India. BCD on compound rubber brought at par with natural rubber to avoid the circumvention of duty. So as you can see, all the duties have been rationalized and benefits are given on the manufacturing in India. Coming to the next change, the legislative amendments under customs containing the exemption and tariff rationalization. It is being proposed that validity of expiry of 2 years on the conditional exemptions, which was initially announced in Budget 21, may not apply to certain notified concessions. Since expiry of period is just approaching in March 23, because 2 years when you count from 21, so 23 is approaching, so it's being expiring. Thus, it is being clarified that such expiry do not apply to the exemptions which are separately provided to the businesses wide multilateral or bilateral trade agreements, foreign trade policy, re-import and temporary imports exemptions, obligations under international trade agreements, and central government schemes. So all these schemes have been, kept separate, and the exemption list has been separately done. Also, it is important to note that out of the choiced 196 conditional exemptions, 146 are proposed to be extended for 1 year till March 2024. Few others are exempted for 2 to 5 years, and balance are being discounted. Further, in continuation to the earlier budget proposals, the import and export tariffs are also being aligned as per HSN 2022 scheme. Let me tell you that this scheme was initiated in the year 2022, which emphasized on adoption of new products in the HSN structure due to the change in the products categories entering into the global market. Coming to the next change, the legislative changes under customs, amendment in time limit for disposal of application by settlement commission. So let me tell you, the settlement commission is an alternative dispute resolution body. So to speeden up the disposal of application before settlement commission, a time limit of 9 months is being proposed, after which, after the expiry of this 9 months, the proceedings shall stand abated and the proceedings will be handled at the adjudication level. So this change has been brought under section 127 of the customs. Coming to the next change, amendment in section 9 of Custom Tariff Act 1975. So it is on the next slide. Right. So in its background, it is important to understand that the Directorate General of Trade Remedies, DGTR, conducts investigation, recommends where the anti-dumping duty and the countervailing duties are applicable in case of any injury to the domestic market from the imported products. Considering the divergent rulings by the courts in India, provisions are being amended to prescribe manner of filing review appeal against the recommendation of DGTR, especially to address the situation where the duty recommendations by DGTR are not acceptable by the business houses. Review of exemptions in case of project imports. This is a very small amendment. However, it is very important to know that to promote the domestic valuation, value addition in solar project segments, the government excluded solar power plants benefits from the project import regulations, Wide Finance Act 2020. Accordingly, the custom tariff heading 9801, which was left unchanged, is now proposed to change and to amend to exclude the head of solar power project to avoid any ambiguity in future. Coming to the next change, key legislative changes in excise, social welfare surcharge, agriculture infrastructure development cess. So first of all, the excise duty, as usually, it is increased on cigarettes, and a very important change, the excise duty is exempted on blended compressed natural gas. Coming to the social welfare and agriculture infrastructure cess, in most of the cases where custom duty has been increased or decreased, the social welfare surcharge and agriculture infrastructure and development cess is also being adjusted to rationalize the overall impact on gross custom duty of products like silver door, gold, platinum, imitation jewelry, electronic vehicles, etc. Coming to the next change in GST proposals, we will discuss the clause by clause changes proposed by the government. The amendments are focused on the clarification and rationalization of provisions to enhance the compliances and reduce the litigations. So it is important to note that whatever proposals are given in the GST will apply from the date of notification issued by the CBIC. So coming to the first legislative change in ITC provisions for ease of doing business and curb tax evasion. Currently, where the recipient fails to pay the amount to the supplier within 180 days, then recipient needs to add the tax liability in their output as per the provisions of CGST. So it is as per the provisions of CGST. However, practically the same amount is being reversed from the input tax credit along with interest in GSTR 3B itself. Thus, to align with the practice followed at GST web portal, this provision to section 16.2 is being amended to include the words payment with interest instead of words addition to the output tax liability, which is not currently happening. Second amendment in this, in the ITC reversal, it has been specifically provided, and this is being a very important amendment, it has been specifically provided that any goods or services used or intended to be used in course and furtherance of business, even in course and furtherance of business, for corporate social responsibility, as defined under Section 135 of Companies Act, are now not eligible for availing input tax credit under GST provisions. So this is one important change. However, it is important to know that this amendment is made in the Section 17.5 on prospective basis, right? So any past things will not impact. Coming to the next change, next slide. This is a change in the Schedule 3, read with Section 17.3 of the CGST Act, meaning thereby the treatment of supply of warehouse goods mentioned there in Schedule 3, which contains the activities which are neither supply of goods nor supply of services. So Schedule 3 contains the services which are not a supply. It is pertinent to note that services which are not supplies does not require any reversals of their input tax, as it cannot be considered as exempt. However, as per Section 17.3, input tax credit on exempt supplies is blocked. So if any service is considered as exempt, then the input tax credit will be blocked. So in order to avoid the litigations, the provisions are being amended to clarify that supply of warehouse goods to any person before clearance of home consumption is now considered as an exempt supply. So whatever input tax credit the people were taking on the warehouse rentals are now going to be blocked. Coming to the next change, legislative changes in the provisions of filing of return beyond the due date. To relax the norms of filing returns, a specific timeline of 3 years is being prescribed for filing of delayed returns in Form GSTR 1, GSTR 3B, GSTR 99C, and GSTR 8 by e-commerce operators. So the applicable, but in this case, the applicable interest and late fee may apply on such filings. Coming to the next change, the amendments in refund provisions. Since the procedure of precise computation of interest on delayed refunds, so whatever refunds, what the taxpayer is getting from the GST authorities, there was no mechanism as such given by the tax authorities to calculate the interest and manner of calculation of interest. Because now the problem arises because after filing of application, there are some other procedures came from the GST authorities like deficiency memo filing or giving the response to show cause notice. So time extends. Thus, in order to promote ease of doing business, the manner of computation of such interest on delayed refunds by GST authorities is proposed to be prescribed under Section 56 of CGST Act. Coming to the next slide for changes in provisions of penalty and prosecution under GST law. So there are certain reliefs given. However, for e-commerce operators, the tax penalties have been provided. So issues are being faced, it has been observed, while allowing the supplies by unregistered persons or composition taxpayers from e-commerce platform like Amazon, Flipkart, and all these kinds of e-commerce platform due to the incorrect declarations and claiming exemptions from registration, even in case of interstate supplies. Let me tell you that in case of interstate supplies, the registration is mandatory under Section 24 of CGST Act, irrespective of any amount. Thus, panel provisions are being imposed on the e-commerce operators to avoid such tax evasions, which may extend to the higher of INR 10,000 or tax involved. So the e-commerce operators has to take due care while taking the applications from the suppliers. In order to relax the provisions under GST on prosecution under Section 132, following provisions have been decriminalized, meaning thereby that these offenses are being excluded from launching prosecution and arrest provisions under GST. Due to the subjective nature of allegations, the excluded offenses are as under: obstructions or preventions in discharge of duties by the officer, tempering and destruction of any material evidence, failure in supply of any information required by the officer, or supplying the false information. So all these kind of three kind of offenses are quite subjective and can be molded by the officer on its own mercy. So the government has relaxed on these three changes so that it should not cause any harassment to the taxpayers. Further, the threshold of launching prosecution on other offenses of Section 132 of CGST Act is also being relaxed from 10 million INR to 20 million INR. So now the prosecution can be launched in a matter exceeding 2 crore rupees. The above measures would definitely result in better governance and reduce the pressure on appellate authorities. Please note that the above relaxations does not apply to the cases of fake supplies or supplies where there are no supplies have been made by the suppliers. In the next slide, next change, to further relax the penal provisions, the charges of compounding in Section 138 is being reduced. Let me tell you what is compounding. A taxpayer who is being, got into the prosecution can also get relaxed from the compounding while paying some tax amount or penalty amount. It can get relaxation from the prosecution. So in Section 138, it is being reduced from 50 to 150 to actually 25 to 100% of tax sought to be evaded. Coming to the last slide of change, a non-obstante clause is being inserted in Section 23, which deals with the persons not liable for registration, meaning thereby it has been clarified by the government that persons who are exempted for registration under GST under this provision are not to be impacted by any other provision of law mandating registration in certain circumstances. Right? Coming to the next, in order to promote ease of doing business, a new provision in Section 158A is being inserted to facilitate sharing of information of registered taxpayers on common portal to other notified persons as per the prescribed manner to encourage transparency in transactions and good governance. Coming to the last change in the Schedule 3, it is already discussed that Schedule 3 contains the activities which are not considered as supply of goods or supply of services. So there are certain list of activities. Out of there, 3 activities were facing litigation from the government that whether they should be taxed or not. So the government has clarified that these 3 activities should be considered as an exempt activity and no tax should be charged. In the caption Schedule 3, it has been clarified that supply within the non-taxable territories, like 2 foreign countries are dealing, and if there is a high sea sale, that the sale has been executed by transfer title of documents before entering into Indian territory, and supply of warehouse goods without clearance of home consumption, which we discussed earlier also, are exempt retrospectively from 1st July 2017. So this has been clarified from the government. So the litigations going on these transactions would come to an end. But a very important point to be noted here is any taxpayers who has refunded back will not get any refund back from the GST authorities if it has already paid the taxes. So that's all from my side on the key amendments from indirect tax, customs, GST, excise. Thank you for your patient hearing. Have a good day ahead. Over to you, Rahul.
Thank you so much, Mr. Vaibhav Matta, for that very informative session. I would like to thank all the speakers today, Mr. Janardan Singh, Mr. Malhotra, and Mr. Vaibhav Matta, for their contribution in making this a very informative and insightful webinar